let's start with SuperSized. First, actually, I want to introduce the panelists here, and the way I want to do that is just have everyone introduce yourself, talk about the size of your fund, and how much you typically invest, and how many deals you invest in a year. And for Brenda, the services you offer. So you're a little bit of a different service. So we'll start with you, Brian.
Yeah, sure. Hi. So I'm Brian O'Malley. I'm a partner at Accel. We have 2 funds in the U.S. that we invest out of a $500 million venture fund, and that is focused on being the lead investor. We typically get involved in the Series A or the seed round, as well as we have a growth fund that is roughly $1.5 billion as well. The unique nature there is that we're typically also getting involved at the Series A. It just happens to be for companies that have reached some scale independent of venture. And the rounds we typically get involved in, so we don't really start with dollars and then work backwards for people looking for big A's. We focus on finding great companies and then figure out how we can get involved with them. And so sometimes that's a $500,000 check, sometimes that's a $2 million check, sometimes that's a $15 million check. So it goes across the board.
Okay.
So I'm Brenda Smith. I'm from CV Brokerage, very different than the rest of the panelists, I'm sure. We're actually a broker-dealer that raises money for funds as well as some private investments. We represent family offices, high net worth individuals, funds as well. So, and we have some pre-IPO and secondary partnerships in something called PRICO market. So a little bit of a unique perspective, I hope, for the panel. Thank you.
Hi, I'm Shruti Gandhi. I'm an engineer turned founder to an investor, where I started my fund, Array Ventures, about 1.5 years ago. The fund focuses on what I call deep tech enterprise companies, so anything from AI, ML, VR, and analytics data companies. The typical check sizes depend on the round. Seed, Series A rounds, which are anywhere around $500K to $4 or $5 million rounds. And the check sizes vary accordingly.
Hi, everyone. Winter. I'm with Sapphire Ventures. We're based in Palo Alto and London. So about $2.5 billion in assets under management. I guess we do directs at an early stage through co-investments with our GPs. So we invest out of 2 strategies. Most of you probably know, if you've heard of Sapphire Ventures, our relationship with SAP. We came out of SAP. You probably also know that we do direct investments mainly at the later stage. But we do have a $1 billion structure. It's an evergreen fund that invests into early stage venture capital firms. And through there, we can do co-investments at the seed or the Series A. That's a 3-person team. I got my colleague Eugene here. He's in the audience. We like to think we have an interesting perspective on the venture space because we're investing at the early stage through venture funds. And we do that in the US, Europe, and Israel. So hopefully the perspective I can bring is sort of what's happening in different ecosystems at sort of that seed to Series A jump.
Thank you. So Winter, let's start with you. You said that you're investing in seed and Series A, but am I correct in saying that you typically write a $10 million, a $25 million check for companies that are already generating $5 million in revenue? So that's not a seed round. That's not a Series A. Is that no. A SuperSized A round?
So again, like that, yeah. Again, like the definitions, like I agree with what Brian said, right? Like it's find a great company, whether that's pre-seed, seed, post-seed, Series A, right? Like you're looking for a great company that has a great team and is getting those good customer relationships early on. I think I'm less of a believer in the post-seed terminology versus just finding a great company. I would not say a $25 million round is a SuperSized A.
What is that round then?
I mean, it's a great Series B or a Series C, maybe even a Series D. Again, like we're trying to find capital efficient businesses. So writing, a $25 million check is obviously going to be later stage. What I've seen, and we look at a lot of market data, so stuff from PitchBook, stuff from CB Insights. I mean, again, I sent out some stuff to the panelists earlier. a typical seed round, like the median seed round is sort of, 2 on 6 that we've seen over the last 2 years. It sort of stayed steady from 2015 to 2016.
2 million with a $6 million pre-money valuation.
Yes, so $2 million round on a $6 million pre-money valuation.
That is the seed round.
That's sort of the median seed, and the median A is more of like, 6 to 8 on probably 16 to 20. So again, like the supersize would be a bigger round than that, right? So sure, if we're writing $5 to $25 million checks, a $5 million check could be, not a supersize, but a $50 million check could be a supersized A round. But again, it depends on the stage of the company when you're investing.
Yeah, I think one thing that I just want to get out there real quickly is it's not like I've got this checkbook and it's like the Publishers Clearinghouse size giant check that you give out and that's a supersized A. We're just giving people funding to grow their business, and we're coming to this world where there tends to be more have and have-nots, where the companies that can attract funding from lots of sources, and so round sizes get pushed up because they can raise at higher prices. And a lot of venture capitalists are solving for ownership. And so they want to own a certain amount. If that means they have to write a bigger check to do that, that's been the pattern over the last couple of years. And then there's a lot of other companies where it's hard to raise money because either their sector is not in vogue, they don't have the metrics yet, and they're just trying to survive and get to the next milestone. And so, I want to focus people don't go out trying to raise a certain size round for the reason of being in TechCrunch and funding is a means to building a great business. It's not the end game, and so Series A is just getting started. I have a company that I invested in called Coupa that went public about 6 weeks ago, and I was talking to the CEO and he was joking about how it's funny people call that an exit. He's like, we're just getting started. This is an entrance. Now we're accountable to the public markets. Mm-hmm. And that's a company that was funded 8 years before. We did that one in 2008. And they're talking about just getting started. So I think it's important to note for the audience that Series A is look, you just raised money. You now owe those people a lot of money back. So, it helps you grow your company, but it's not the end game by any means.
I just wanted to add also to Brent's point is the alphabet that people raise is based on what they raised previously. If they started with an A, could be A plus, A2, B, or if they raised a seed, it could be post-seed. I think it's more the check sizes and what their metrics look like that matter.
Yeah, I totally agree. I just want to make sure that, I'm glad you cleared it up that you're writing, $8 million checks. I just thought that you were only writing $10, $25 million checks. And for a lot of these people, a lot of these entrepreneurs, I don't think they have the metrics to even ask for that size check. So let's talk about that. What, for Series A, which is, you said, winter is about $8 million, $10 million, right? That's what you're saying is about $8 to $10 million?
I would say it's a little smaller. I'd say the larger funds like an Accel could write a bigger check, right? I also think the dynamics, again, if you have a really strong team, you can command a little bit higher valuation, right? And for some of those, venture capitalists that are more focused on getting ownership in those rounds, that might lead to a little bit larger round size to make sure they have that ownership there.
So what do they need? What kind of metrics do they need? Do they need to be ready to scale? Do they have to have their unit economics down? They can't, 10 years ago, it used to be you get a Series A to launch your product. That's not the case today. They need to have customers. They need to be growing. And what are the metrics to get a, let's say $6 to $10 million check? Brian.
Sure. So some of this is just a change in nomenclature, right? So 10 years ago, a Series A was a $3 to $5 million check. A lot of companies these days are raising a $3 to $5 million seed round. So some of that is just a change in nomenclature. But I think when you think about metrics, a lot of times people come to me and they say, hey, if I hit X revenue, will I be interesting? Or if I hit Y number of users, will I be interesting? And the first thing you need to sort for is how excited is that particular investor in whatever category you're interested in? Because someone could show up to me tomorrow with 10 million users or 10 million in revenue in a category I don't like, and it's not relevant. And someone else could show up with a plan on a napkin, and I'll give them a check on the spot. And a lot of that comes from what's that investor's background, where do they invest, where have they been successful, what do they do as a founder or entrepreneur before. And so they're approaching the world with that concept of a prepared mind and what they're excited about. And that's why, like, a lot of times you get these emails and it's like, hey, we're really excited to work with like Accel partners in like a different font, clearly like cut and pasted from like some forum email. And it's just like, that doesn't work.
Do you throw away those emails? Do you just like disregard it?
I don't print them out and then throw them away, but I do hit the old delete button. Although I might want to start printing them out and throwing them away. That would be therapeutic. Yeah, that would feel good. I also get a lot of like dear brain because spell check doesn't fix that. But yeah, my parents didn't think about that when they named me. But yeah, so a lot of it comes to, hey, does someone, like, whether they reach out through a mutual contact or they just send you a cold email, if that's written well, and if it's like, hey, you invested in X company, and I think that's a great company, and we're similar in these reasons, like, you're gonna maybe take that meeting more prematurely, regardless of their metrics, because they spent an ounce of effort trying to understand what you're excited about. And a lot of us, even if we know we might not invest for a year, like, we'll want to get to know that team because they were thoughtful about how they go about it.
Yeah, I think that's right. You sort of need to figure out like which firm to approach based on what they've invested in the past. And if you want to really raise a SuperSized A round, make sure you're aligned with that firm. I mean, you could be a great business with millions or tens of millions in revenue, and if you're a gaming company and the firm doesn't invest in gaming companies, again, it's not going to be the right fit to sort of be the firm that invests in your SuperSized A.
And Brenda, I will get to you, but I just want to ask Shruti, because she is really investing in the seed mainly, right? You're not doing Series A or post. Are you doing both? Okay.
But I always, for both rounds, when you talked about metrics, and a lot of companies haven't had a chance to maybe get those metrics of million ARR, over 100% growth, whatever that is, right? Mm-hmm. The right formula. I always tell the founders to think about it as like more of a emotional sell more than a metric sell. So, as to Brian's point, like, is the investor going to get excited about what you're doing? So find those investors that you think, and so you have to do a lot of homework. You have to then go about really being personal around, this might be interesting to you. We don't have the right numbers, but here's why I can show you in the next 3-5 years, this is better, and take the meeting with me, and I'll teach you something in return, but do take the meeting with me. And so that's the emotional sell and the reason why that round might even happen.
A lot of times, like, the milestones you're looking for, it's not the milestones that are easiest. It's the milestones that de-risk the business the most. And so having conversations with investors just around, hey, if I showed up in 6 months, like, what would you be wanting to see from me? And then a lot of what you're looking at, because again, Series A is still very early, you're looking at essentially plotting a line, right? And so if they come to you multiple data points and they're on the trajectory that they said they would be, you're gonna have more belief that what they say they're gonna do next, the team will actually accomplish. And so a lot of times I have people show up and again, they're looking at these like vanity metrics around like number of users, or they're looking at, hey, if we hit 1 million in ARR and now all of a sudden we're interesting. Right. Where for some companies I'm like, look, hitting 1 million in ARR in your business might not be that hard, but I actually want to see like what's your daily use of those users, or what does the upsell potential look like when you get in the door, or whatever it is. Like metrics tend to be very focused on a particular company, and the more generic the milestones are that an investor talks to you about, the less they probably understand what's unique about your business.
So 25, I do want to bring Brenda into this. So $25 million for a SuperSized A, that is the exception. That doesn't happen as often as we might think.
Who has seen like a $25 million Series A?
Okay. It's all the press. Everything, they're just making everything
Three
up.
people.
3 people. Okay, that's it. Although Brenda is sitting on this panel because she is actually seeing something very interesting. So it used to be you would get a Series B, Series C, and a founder could liquidate, or team members could liquidate. What Brenda is seeing now, and I think that's partly due to the fact that we're seeing larger Series A rounds, is she's seeing a lot of founders liquidating at a Series A. Is that correct, Brenda?
I would say that, and just to reiterate, I am very quiet up here, but I mean, a lot of what we do is to try to find the right investor with the right companies, just so that you all realize it's not only the funds out there, but others like us that try to make sure. I'll have a request come in from a family office, for example, that's looking to write a $50 million check or a $100 million check. So part of what we do is to try to seek out those really great companies or something that they already have in mind. So investing does work that way as well. And as far as the question regarding people getting out or seeking liquidity, I wouldn't say it's only the CEOs, but part of the biggest request that we've seen lately, and particularly pre-IPO, which is a little more advanced than what we're talking about here, but still an area that I see a lot, is some of these employees, it's almost like 100% of their net worth at this point is wrapped up in that one single security that they, from their employer. And I have seen that employers are willing to have them have some partial liquidity because they need a little bit of diversification in their portfolio. And that I have seen to be quite evident in the last.
Are you seeing secondaries and Series A's?
I have seen secondaries in that, and we actually do have an electronic matching engine. I'm partnered with someone in New York that we do that, and so we see it a little bit there as well.
And that's, I mean, great, because they're probably large Series A, but how do you guys feel about that as somebody, a founder coming in, getting a Series A, and then wanting to liquidate? It seems a little bit too early for a founder to want to liquidate at that stage.
Yeah, if it's a founder, it's probably too early. I've seen some where people have tried to buy out someone that might not be the best actor for the benefit of the company. Like I agree with that. I mean, but I think it's slowed down. But there's still a lot of active conversations around, secondaries that we see at the B and C, less so in the A. I don't know if you.
Yeah, I mean, just frankly, that would scare the crap out of me if someone's trying to first of all, a $25 million A, if you look, the data shows that a lot of those really big A rounds for companies that are pre-revenue. So this is separate from the bootstrapped Qualtrics, Atlassians of the world that have reached some level of scale. A lot of times these really big A rounds, they don't work because part of the goal of having the right sized funding based on the right milestones for that company is for people to be super disciplined. I had a company once that was, we did the A, it was a business called Vidi, right? And this is one of the ones that didn't work out so well for me, where we raised an A, and it was a $6 million A. It was very normal sized. And then the company took off and we did a $30 million Series B 2 months later. But the company didn't have a big team. And so they had roughly 14 years worth of cash. And it kind of evolved into we had, it was 7% dilution, so we're might as well take the money. But it totally changed the behavior of the business where I kind of likened to they became sort of like a trust fund company where there just wasn't the same level of urgency. Now they were thinking about big distribution deals versus just solving the particular product features that were needed.
Yeah.
So I think some of these bigger rounds, and by the way, I work at a bigger fund, and a lot of the bigger funds are causing some of these challenges. But there is a certain round size that just scares us because it's not the right level of discipline or focus that you want. And especially if the team comes to you saying, it's time for them to take some money off the table and get some sweet car, that's just the wrong setup.
Right. But aren't you you're not you're forcing, but you're encouraging them. When you have $1 billion fund and you have to put money to work, even Chamath was on stage talking about how come we're trying to squeeze all of this growth within 2 to 4 years. And these companies, sure, asset values can go up pretty high, but you're still trying to, it seems like you're trying to give startups a lot of money that they don't need. And I mean, do you think that sometimes you do that and you're forcing them to spend this money, make expensive mistakes, and just compete against each other? It's the wrong mindset for a startup.
I don't see very many $25 million Series A. So I think to ground the conversation, it should be a supersized Series A for me is $8 or $10 million really. So the $25 million really shouldn't be part of the conversation because it's so anomalous to what actually happens most of the time. If you are raising a really big Series A, it's usually in some true innovation that requires a huge setup or something, right? Yeah. And so the capital, if it's spent wisely, can get you to proving some new model or new technology versus most companies here, I think when they're raising or looking for a supersized Series A, it's more about the metrics of that company at the point in time to show that and other characteristics of the company to show that they have a great team. The quality of the revenue is super high. And again, like there's a bunch of characteristics going into, the understanding from the Series A investors' perspective that this is a great company that I want to, it's starting to prove out early with their model. Like I want to put in a bigger check to help them grow faster. I don't think that check conversation is around like a $15 million check.
Yeah, I don't want to belabor this point, even though the title is called SuperSized A. So let's dispel this myth that there is such a thing as SuperSized A, or that's the norm. It's, an A round is 8 to 10 million or so. Correct? So I want to, because we only have 4 minutes, and so I want to touch on something. Winter, you talked about innovation, and I think there's going to be a lot of innovation in 2017. We have a new administration. Semel brought this up with Chamath earlier in his fireside chat, and he asked, well, what is the election, is that good, neutral, positive for our industry? Right. No, Brenda, let's start with you.
I completely stay out of politics, so I'll pass on.
Okay.
It's not a good place for me to be.
Brian, you want to?
We're still kind of trying to figure out what it means, and we're looking at the cabinet appointments and trying to figure out what all that means. So,
Okay.
I don't know. It's something that we watch closely. Like usually, our companies do not succeed or fail based on any sort of broader political mandate or based on any sort of federal government type involvement. Like sometimes they can get shut down because of that, but that's very, very rare. Usually they're playing on some broader secular trend and capitalizing it with the intersection of the right technology at the right time. And so I think the one thing that the election highlighted is just how much technology is being built for the other people in Silicon Valley. We kind of liken it to like if people are talking about it on Caltrain versus if people are talking about it, at a truck stop or at a Cubs game or somewhere else. So I think the secular trends that really became apparent during the election is just like how much technology is built for people living here versus people in the rest of the country or around the world.
Yeah, I mean, again, I think maybe it has some implications for media startups and how they think about incorporating like AI into those companies. Aside from that, like if anyone really wants to check out sort of policy, like look at all the stuff that the NVCA is doing, right? Like they sort of have a pretty comprehensive overview. They had a call yesterday. Like look at that video or listen to that conversation. Like it's pretty comprehensive of so far what the appointments mean for potential policy that's going to affect startups in 2017.
Well, I think one thing that it highlighted was that we need to create jobs. And I think one thing Silicon Valley is really good at is creating asset value, but not that many jobs. So you have WhatsApp, 55 employees, $19 billion, Facebook, $350 billion or so, and 13,000 employees, but you have something like Walmart where $250 billion in market cap, 2 million employees, 1 million in the US. So how do we get Silicon Valley to create value, but also create jobs? And I know there's a multiplier effect with tech jobs. For every tech job, there's 4 other jobs. But I think that's sort of the direction or something we can think about. Don't you think that makes sense?
Yeah, I think it's sort of a virtuous cycle at the early stages. There's a lot of companies always being formed, right? There's probably per year 6 to 8 billion that goes into Series A in the US and maybe like 1 or 2 billion that goes into pre-Series A companies. That's going to be a lot of capital going into paying people's salaries. So I don't think that goes away necessarily. And again, like if you look at the fundraising data, because we sit on the LP side of the aisle as well. Like there's going to be probably 40 billion or so of capital raised this year. So that's going to go into startups, and I think that continues to lead to job creation. It might not be at the same company, but I think there's going to be a lot of capital out there hiring.
Yeah, I would agree with that completely. I mean, I see pools of capital, as I call it, just virtually waiting to find the right opportunity, the right investment opportunity. So I think for the right opportunities, there's plenty of capital available.
Right? Okay, you guys might not like this question, but I'm going to ask it anyway. So,
we love the politics
President-elect Trump proposes raising carried interest rate to 33% from 24%, even though it's less than 1% of the revenue that we're going to see over the next decade based on relative to the other revenue that's coming in. It's an interesting sort of philosophical sort of what is your point of view? Do you think it should be raised? Do you think it should be capital gains? Do you have no opinion? I'm always looking at you, Brian. Sorry,
We'll deal with this one. Look, I think the problem with the conversation is that all carried interest, and just so you guys in the room know, carried interest is how we make most of our money at the end of the day. A lot of times carried interest is bucketed in terms of all private equity together, right? And when I mentioned the NVCA earlier, one of the things that they're really trying to separate out is the buyout company that shuts down 5 factories and moves jobs offshore in order to make a bunch of money for their general partners is very different than the early stage technology startup company that ends up creating an ecosystem, thousands of jobs along the way, and is starting out with a company where the net asset value of that business is 0. The challenge is in Washington, we as a private equity industry more broadly gets lumped all together. And what we're trying to do as venture capitalists, and some of this is certainly self-serving, but one of the things we're trying to do is separate the conversations between, look, who's creating jobs and who's helping the American economy get stronger versus who's playing financial asset arbitrage and essentially like terminating jobs and getting rid of jobs in order to make more money from themselves. And those have 2 very different impacts on the greater population and should be treated separately.
Right, but people who are taxed on ordinary income also create jobs. And so the question isn't, are you creating jobs? Is what you're doing, should it be taxed on ordinary income or capital gains? But
well, I mean, just real quickly on that, we do get taxed on our ordinary income,
Yeah.
right? If you start a business, you know, and that business grows and is worth a lot of money down the road, you don't get taxed on that in the same way.
I will just add a very slightly different perspective is in venture capital, not private equity. In the last couple of years, there's been a trend with micro VC rising. Often they take very minimal or no management fees, so they're working for the carry, and if they're lumped into the private equity conversation, it's a little difficult.
okay.
I'm set.
Okay, all right, well, time's up, and the panelists will be around, so if you have any questions or if you're looking for a Series A, not a supersized A, but a
That's right.
Series A, they will be here. Okay, thank you so much.
Thank you.